Okay, so I know it has been long since we met. Yeah, we have been both busy,
Oh yeah.
but that should not be an excuse for not having these lessons. So in any case, last time we met, we looked at the financial statements, but that was part one. Today, we move on to part two. We'll be looking at property, plant, and the plant, property, and equipment, which is governed by standard code IAS 16. So
It's my pen.
first thing first is that you first need to appreciate what these assets are. Eh, those old golden days, we used to actually call them as fixed assets.
Oh yes.
They are still fixed assets, but financial or accountants decided to start calling them using some fancy names, non-current assets. I will not go there that route. So I'll still maintain the fixed assets.
Okay.
Yeah. So these fixed assets, eventually they have to sit on your financial statements, on your balance sheet particularly.
Yes.
But for them to sit there, there should be a process in which they should be recognized. How do you recognize them? That these are assets and these have to sit on this particular line. So we'll look at the initial recognition of property, plant, and equipment.
Okay.
So the question is, when should we bring the PPE into the accounts? There must be a process, like I said. Okay. Sorry. So when should we bring PPE into the accounts? When should we actually introduce the fixed assets on our balance sheet, or what they are now calling a statement of financial position?
Yes.
We first need to recognize these PPEs. We need to recognize them when, one, it is relevant to do so. Secondly, the item is faithfully represented. You don't come up with numbers that you cannot substantiate. You cannot justify. They'll have to meet the definition of an asset. We know that an asset is something that is valuable, that has value. It's
Yes.
something that we know that we can actually expect economic benefits to flow, because anything of value, we expect economic benefits to flow to us as an organization, as the holders of that particular asset. And this is why it is called an asset. Otherwise, it would actually be a liability to us.
Oh yes.
So what gets included in the cost? One is those costs that are directly attributable to the work, to the actual work. For example, you're actually going into this real estate. In any case, that's where you are. But now this new job, it will involve, you will be in this company where they actually construct the properties, buildings from the ground.
Oh yeah.
So all the costs that are direct costs or primary costs, or what you call as prime costs, all the prime costs, these are costs that are directly attributable to that particular product. In this case, it could be a house, anything of significance. So all those direct costs, you will need to actually include them. These may include site preparation, delivery and handling, installation related professional fees for architects and engineers. Those are direct costs. You may also have the labor costs that are directly attributable to producing that particular asset. In this case, it could be building, a part of its total cost of production. So you know that you have these directly attributable costs. Then you also have a reasonable proportion of indirect costs, which you then now allocate to this product. Obviously, it could be different costing methods that one would use. One of them would be actually absorption costing. So may include those indirect costs. These are overheads. You may have actually borrowed. And where you're going in that particular industry, most likely there's a lot of monies that is borrowed.
Oh, yeah.
Because it's cheaper to use debt than use equity. So during construction, you may be required to be paying interest. It could be in kind, or you start paying in actual. But in any case, they are all costs. Those costs, they'll have to be part of your product. They'll have to be part of your asset.
Or the cost of the whole asset or the
Yes. And that interest is what we call IDC. IDC is interest during construction. It has to be capitalized.
Okay, interest during construction.
Mm-hmm. So interest incurred on capital borrowed to finance production of the asset is a relevant production cost when a company is constructing an asset for its own consumption.
Yes.
Mm-hmm. Again, you must be able to forecast what will be the dismantling cost after this particular asset has done its time. It will need to be decommissioned maybe at 20 years, after 25 years or so. Us who are actually in the energy sector, we do understand that for example, solar plants, they will reach at a stage where they are no longer useful. Maybe it's after 25 years. So all that decommissioning costs, it has to be included as part of your pricing, as part of the asset.
Oh, repeat that. That's the end. Like solar panels, they what? Sorry.
Yeah, solar panels, because you have solar farms. Those solar farms, they cannot be there for too long. They can only be there for a specific period of time. It could be 20 years, it could be 25 years. But afterwards, then you need to dismantle them. So that dismantling cost, where does it go to? It should be capitalized. When we talk about capitalized, what we mean is that it should be part of the total cost of that particular property, plant, and equipment.
Okay, the costs of this are included. Okay.
So now the issue here is that this cost is going to be incurred, say, in the 20th year, in the year that you're dismantling. So you need to value it today. This is why now you bring in discount. You have to discount it today. So the discount factors play a major role. So as a production plant must be dismantled at the end of the lease, the cost of dismantling are included, but they have to be discounted.
Okay.
Because your $200 that you're going to spend in the 20th year has to be valued today, because you're making a decision today. And that's a cost that you're going to include in your property, plant, and equipment.
Okay.
So an asset is basically a vessel that you use for value, to create value. Because without an asset, it becomes difficult. How do you create value? So you must have an asset. This asset could be liquid cash that you have taken into treasury bills, into government bonds, and you're making those coupons. That's the value that you're generating from an asset. And these are liquid assets. But currently, we are looking at the non-current assets, which are fixed assets. Why should an organization have a fixed asset? Why should they have a fixed asset? The reason is simple, because they want to generate value from there. And the value
Oh.
that is going to be generated is what you're going to see in the income statement. That's revenue.
Oh, yeah.
But because this particular asset is supposed to live for a particular period of time, it has a lifespan. So whatever revenue that has been made, for example, you have actually made a revenue of, for argument's sake, revenue of 20,000. You have made revenue of 20,000 pounds in that particular year. Okay, let me say dollars. This is your revenue.
Yes.
This revenue is being created by an asset that costed you or to acquire, or both. That costed you 500,000. Sorry. And this is your annual revenue that you have made.
Oh, from the assets that you bought for 500.
From the asset.
Okay.
Revenues are actually generated from assets.
Oh, yeah.
For anyone who has revenues without an asset, it means that person is involved in money laundering. That's what it means. And don't even go further than that.
Wow.
You cannot generate revenues without an asset. So that asset could be your treasury bills. You have them in your you have bought treasury bills. You have bought government bonds, treasury bonds. That is your liquid asset.
So would you class labor as an asset to a certain extent? I know they're like you have salaries and overhead, but I'm just saying your employees are an asset, aren't they?
Your employees, yes, your employees are actually what we call now as a human capital.
Okay, yeah.
Which is an asset.
Oh, yeah.
But it's not possible to generate revenues without something of value. You are generating revenues, which you are calling as a salary on a monthly basis, because you are a human capital, you are an asset.
Yes.
Anyone who generates revenue without an asset is either involved in magic, which obviously would be very difficult to justify, or it's money laundering.
Oh.
Or one getting a bribe.
Oh, yes. Sorry, Mr. Can I just tell my daughter one thing? Just Nochulo.
So just understand this concept. I want to explain the concept of depreciation so that you understand it.
Okay.
Or properly.
Oh, yeah.
So you have generated this revenue from this asset. This is an asset. So if one was to ask you, this revenue that you have generated, what proportion of your asset was used to generate this?
That's it. Now my math's coming in, huh? I'm lazy. Hold
so
on.
Now you need to ask yourself the question, if one was to ask you that question, that what value of your asset generated that $20,000 in this particular year? So the first thing that you need to ask yourself is on the lifespan.
Oh, yeah. Okay.
So that you only apportion a component of this asset to this value that you have generated. You get me?
Yes.
So if the lifespan is 50 years, then I know for argument's sake that the value of the asset that was used to generate this revenue is the 10,000.
What, 50 over?
$10,000.
Okay, yeah. So 500 divided by 50.
So this is the value. This is the part component of the asset that was used to generate this value for me. This is now what they call as depreciation.
Yeah. Okay, that makes sense.
So if I generated 20,000 and the lifespan of this asset was in 1 year, then I know that for the 20,000 that was generated, it was generated from an asset of 500,000 that expires by the end of the year.
Yeah.
I've known that this particular asset is a lazy asset because we spent 500,000 in acquiring this asset, and it was only able, by the end of its expiry, it was only able to generate 20,000.
Oh, yeah.
So depreciation, a lot of people, you as finance people, you look at it as a non-cash item. But as you go further in project financing and understanding the world of project financing, you realize that depreciation is an asset. It's just a component of this particular asset, which you want to apply to the revenues that you have generated in that particular period through an accounting concept that you call matching concept or accruals concept, which states that revenues earned must be matched against expenses incurred in earning it. Basila.
Oh, okay. So that's why, yeah, okay. Yeah, the accruals concept. Okay, matching concept.
So when you look at this depreciation, it is basically an asset.
Oh, it's an asset.
It's basically the value, a component of an asset that you have used to generate this 20,000. So meaning that if I know that, then I know that the cost of this, first I'll put my revenues as 20. Of my depreciation, which is 10.
Yes.
As a cost. This is the cost that I use because your asset, this is a value from this asset, a component of the cost of this asset that has helped you to generate this. So if you have other costs, I'll put those costs and I'll be able to get my profit. In this case, it will be 10 if I didn't have any other costs other than depreciation. So this is now what you're actually going to call your bottom line.
Okay.
This is why depreciation is subtracted. This is why depreciation charge is regarded as an expense in the income statement. In actual sense, you're actually saying this is just a component of this particular asset. So when you go into the subsequent year, you are not going to have 500,000. It will be 500,000 less 10,000. Which then again you continue apportioning on a yearly basis as you generate this revenue. So like I've told you, it's not possible to generate any form of income without an asset.
Okay, yeah. So on your P&L, you're showing the cost, the depreciation charge every year.
Mhm.
Then in your balance sheet, you're accumulating that until you get to the
Until
50
you go
years.
to zero.
Zero, yes, okay.
Or whatever number, if you had at all, there will be a scrap value or residue
Yes.
value or some terminal value of some kind.
Oh, yes, okay.
Mhm. Okay, understood.
Yes,
Happy.
thank you. Very good, yes.
Okay, so this is basically on the depreciation.
Mm-hmm.
Mhm. I think I've already explained on allocating it on a systematic basis. I've looked
Over
at
there.
the natural reason why depreciation is actually included in your income statement as a cost depreciation charge.
Oh.
Mhm. So the residue value, or what you call use and use of economic life, should be reviewed at least at each financial year end. You look at what is this use of economic life. If expectations differ from previous estimates, any change in accounted for prospectively as a change in estimate. So you can do all those things. Mhm. So the question would be, which method of depreciation should be used? You need to actually make a well-informed judgment. You actually need to check the pattern in which your assets' economic benefits are consumed by the enterprise. Then you decide whether you're using reducing balance, whether you're using sum of digits, whether you're using a straight line. That will actually be determined. For example,
I've never heard of sum of digits.
I
only know the two, straight line and reducing balance.
Yeah, but you see, for sum of digits, you'll find expression like this. I know today we're not there to look at the computations. We'll do that. If you have 1, 2, if that's 3 years, for example. So your sum of digits, you start maybe 1/6. That's your depreciation. Here it will be 2/6. You move on 2/6, 3/6 times the value of the asset. Now, when you start looking at those things, depending whether they are in your syllabus or they are not in your syllabus.
Okay.
And also, it depends on the pattern in which the assets' economic benefits are consumed. That's where your decision can come from.
Okay. Methods be reviewed at least annually. Okay.
So how often should depreciation methods be reviewed? You can be reviewing them at least annually, on a year basis. That is if the pattern of consumption changes, the depreciation method should be changed prospectively as a change in estimate. So there are provisions.
What factors do you look at when you're doing that? Sorry, I'm asking this question because I'm thinking, I think it's one of the things.
For example, this particular asset of yours, there's a statutory requirement that maybe you should now, or it is environmentally toxic. And before that, when you bought that particular asset, you knew that its lifespan was 20 years. But you're being told that in the next 3 years, there should be no more of this particular asset.
Oh, yeah.
So it changes the way your depreciation is supposed to be accounted for, because now the pattern changes.
Okay, yeah. Because I think it's something I need to look at. I think something I'll need to do before I leave. Look at all the, because we've come to the year end, I need to look at review whether our depreciation charge over the year has been reasonable and whether it either needs to be reduced or increased. But I just didn't know what factors. So this is good.
Yeah, sure.
In terms of the factors to look at.
So I've already explained on the accounting treatment of this particular thing. You may find, and it's possible in the aviation industry, where SIM card parts are depreciated separately, say, for example, for a plane. So you depreciate certain assets in different ways.
On the plane itself.
Different lifespans, yes.
Oh yeah, okay. Like the wing can be different to
Mm,
whatever. Okay.
yes,
I get
absolutely. So if the cost model is used, each part of an item of PPE with a significant cost in relation to the total cost must be depreciated separately.
Okay.
So parts which are regularly replaced, depreciated separately. So the replacement cost is then added to the asset cost. When recognition criteria are met, the carrying amount of the replaced parts is recognized. So you derecognize that asset that you're moving, whatever. When you are replacing, you then recognize using the current cost. That is fair
Uh,
using this cost model.
so you know what I wanted to ask? For
Taking
instance,
out an
if an
asset
Mhm.
that possibly this particular asset at the time that we're buying, maybe it was R5 or $5.
Yes.
Then as we replace it, we are replacing at 7. So I'll introduce a replacement cost and recognize the carrying amount of that particular asset.
Okay. Sometimes what if it's, like my boss, we've had instances where the air conditioning system has been replaced and she said no, we cannot capitalize it. It goes under repairs and maintenance. So when do you decide that it's repairs and maintenance or it's an act or you capitalize if it's significant parts are depreciated separately? Okay.
When
The cost,
significant.
the
It
cost
may
model.
also be a matter of policy as an organization. You may say anything that goes beyond £1,000 will be capitalized or be regarded as a capital cost.
Even
Anything
if
below
it's
that, yeah.
even if it's a
Anything below
replacement.
that, you just regard it as just a normal expense that goes. In any case, even the costs that are in the income statement, Zara, you need to know that they eventually find themselves in the balance sheet and the equity. They find themselves there
Okay.
because your expenses is just one of the variables for your computation of your profit. So you have revenues, you have other expenses. Whatever you get there as your residue profit, certainly it actually goes straight into
Oh
your
yeah.
retained
Balance
earnings
sheet.
into your balance sheet. So at any given time, the balance sheet and the income statement, they are very symbiotic. They benefit from each other.
Okay. Yeah, I was just wondering when do you because my boss has always said if it's replacing and something like an asset on the building, because it's not considered as part of the original cost, she puts it in repairs and maintenance rather than capitalize it.
Yeah. So again, that one also is a problem because if it's significant, you know what it does? It wipes out all your profits. It's
Yes,
even
of
better
course,
that
yes.
it goes to assets. If you believe that there's an asset appreciation, if that particular asset is going to appreciate in some form, some kind, because it's significant, then it's just that you capitalize that so that your asset value goes up.
Yeah, I've never understood that where she says no, because it wasn't the original cost, it's a replacement. So it should go into repairs and maintenance.
Mhm.
Okay. You're drinking Coca-Cola.
Yeah. Oh, to distress me. Yeah. So the major inspections for faults. We are now getting back to your conversation with your boss.
Yeah.
So the inspection cost is added to the asset cost when recognition criteria are met.
The
So
inspection.
whatever costs that are incurred when you're inspecting this particular major or significant part, your inspection costs will actually be added to your cost, will be capitalized.
Mm-hmm.
So if necessary, the estimated cost of a future similar inspection may be used as an indication of what the cost of the existing inspection component was when the item was acquired or constructed. So you're actually using historical information as a
Okay.
basis for your cost capitalization.
When the item was acquired or constructed. Asset included with a different use for economic life.
For an asset is a component included with a different use for economic life, where it has a different economic life. So this could be something like land and buildings. Basically, you should take the land value away from the total cost and then depreciate the remainder over the useful economic life of the building. And we normally do that. If say land and building is 50,000 pounds and building is 10,000 pounds from there, so your land is 10,000. So you remove land of 10,000, you remove 40,000, that is what now becomes as a depreciable amount.
Okay.
Mm-hmm.
Oh yeah, because land you never ever depreciate land.
Yes, yes. These are just basically computations, basic computations, because you are saying you buy a house for 100,000. The land has a value of 40,000. So to be 100 minus 40,000, whatever number you get there, which is 60,000 divided by 10, then it gives you your depreciation.
Okay.
Which is your 6,000. Sure. Because land is not depreciated as we are taught.
Oh yeah.
So after the initial recognition, you are recognizing this particular asset where you are looking at the direct cost, the indirect costs, inspection costs, interest, whatever, installations and all these things, the cost, the estimated cost of dismantling that particular asset after its economic useful life. That is your initial recognition. Whatever value you get there, that is what you're going to plug into your financials.
Okay.
Now, now you're looking at subsequent recognition. After the initial recognition, what are these things that need to be looked at? So under the cost model, which I had already looked at, you are actually going to look at the cost of this particular asset, less your accumulated depreciation. So depreciation should begin when ready for use, not wait until actually used. So you begin depreciation, not necessarily when the asset now you have started using it. You begin depreciation when that particular asset is ready to be used, you start depreciating. So depreciation should begin when ready.
So you buy the asset, and if you haven't started using it, you do not start depreciating, basically, right? Until you
But
start.
then when you are ready, when that asset is ready for use, for some reason, you haven't just switched it on, but it's ready for use. Depreciation should begin when ready for use, not wait until actually used.
When ready for use?
Yes, when ready for use. Then you start depreciating. This is a cost model.
Okay. No, I'm trying to think of.
Because imagine you buy vehicles for your company, and you keep them in your parking lots for 1 year. Why did you even buy them to start with? Because ideally, when you bought them, then you are ready to use those assets. And maybe it's fair that you start depreciating them.
Okay, so yes, no, I'm just trying to think. So I'll tell you what has happened where I work. We basically have an IT system. So we subcontracted a new IT company, and they asked us to purchase like different portals, wiring, or whatever it is. Spent quite a bit of money, like close to £100,000. But we haven't started. We've paid them. They bought that stuff. They just haven't started installing. So until they do that, that's when we'll start depreciating. It's that amount, the cost is sitting on the balance sheet at the moment.
Yeah, so when you are ready, this is what the question, the whole key word here is ready for use. Because if you don't follow this logic, then you can be manipulating depreciation. Why you say, we have kept these vehicles, we're going to keep these vehicles for 6 months, and they will only depreciate for 6 months. Again, the other year, you decided to keep them so that they start lazing around.
Oh, yeah.
Unless now you're actually saying that particular asset that you bought is held for sale. Then if it's held for sale, there's a standard called IFRS 5. Then you're not going to depreciate during that time that the asset is held for sale. Otherwise, it has to be depreciated. Otherwise, it becomes now vulnerable for manipulation if you don't stick to this.
Okay.
That was on the cost model that we looked at. Now we look at the valuation model.
So cost
On the
model.
valuation model, fair value at the date of revaluation, less depreciation. So at the date of revaluation, come up with a fair value. Yes, this phone at cost model, the cost model is very easy. This phone, the Techno, the cheap Techno, I use a cheap phone, the cheap Techno, less the accumulated depreciation. The cost at which I bought this Techno, less accumulated depreciation.
Oh, yeah.
That will be in the subsequent period. That is a cost model. The revaluation model, I would say at the time that I'm revaluing this phone, what is the fair value of this phone? Then less your accumulated, less your depreciation.
So cost model and
Cost model and the revaluation model.
Revaluation, yeah.
So at the date of revaluing this particular asset, I need to know, and what is the depreciation from the date of revaluing to the date in which now it should actually sit in the financial statement at the year end or quarter, whatever it is. This side is very easy. This Techno phone, say it costed $100. And I've used it for 3 years. The economic lifespan of this particular phone is 5 years, for argument's sake, meaning that every year we'll actually be taking out $20. So now, because it's for 3 years, it's only $60 that will be regarded as depreciation.
Yes.
As dip, which then gives us 40 in the subsequent year. In the other scenario, if I'm using a revaluation model, I'll look at what could be the fair value of this particular phone. Obviously, there are a number of phones, versions that have come in now. It's no longer even making sense. Maybe the fair value of this particular asset, of this particular phone is $25.
Yeah.
At the revaluation date. Then I'll charge depreciation. If depreciation is 20, by the end of the period, it will be 5. That's the revaluation model. So if we follow the revaluation model, how often should we revalue? The standard says revaluation should be carried out regularly. Regularly could be 5 years, could be what? Regularly doesn't have an answer when I say regularly. But in any case, we are saying that the revaluation should be carried out regularly. So for volatile items, this would be annually. For others, it could be 3-5 years. For the industry that we are in, maybe this energy industry, you deal with hydropower stations, you can be revaluing every 5 years, you revalue your assets. But for those that tend to change, especially phones, which are volatile, you can be revaluing them every year. So which assets get revalued? If an item is revalued, its entire class of assets should be revalued as well. I cannot just pick one house among many houses or properties that we have and revalue it. We have to revalue all the classes, all those assets or houses that are within our portfolio.
Oh, yeah. So, and to what value?
obviously, market fair value, it means, market value. The problem with market value is that you cannot use a word market value when you are dealing with a revaluation model, because market value is very subjective. It changes every day.
Oh, yeah.
You cannot cope up with market value.
Value. Oh,
So
yeah.
you use a fair value, which is ideally a market value for that particular period when you are doing your referencing.
Oh, yes.
You get me? But then the fair value is more of a disclaimer that this value may not be the market value, but at the time that we are getting this number, these are the values of these assets, the cost of these assets, similar assets, whatever it is. Because every day, every minute, the market value changes.
Changes. Oh, yes.
So specialized properties will be revalued to their depreciated replacement cost. So you know for sure that, okay, this particular asset that we have, the techno, at what, if I was to replace this same asset, how much would I actually spend? That depreciated as it is. So then we'll say this one would actually go about 5,000 in Katondo, 5,000 kwacha in Katondo, or 2,000 kwacha, or 100 kwacha in Katondo. Then I use that now as a basis to revalue this as 100 kwacha, because that's a replacement. This is what they're saying. Specialized properties will be revalued to their depreciated replacement cost.
Okay.
You may even face a lot of challenges. For example, power station. I'll give you an example of power station like maybe Vic Falls, where it was built possibly before 1937. So obviously you expect that maybe even the machines that are in there, possibly there's no one who's able to manufacture them. Oh, because they are old machines. But you can actually look at the replacement. What would be the depreciated replacement cost of this? So it's okay with this. If it was whatever, use certain assessments, historical, whatever it is, and say this will be the issue. This will be the value.
Okay.
So the accounting treatment of an asset that has been revalued. If it has been revalued upwards, what you call revaluation surplus, so you expect that there's an appreciation of that particular asset. Always remember this thing. Any increase in assets, you debit the asset account. Any reduction, you credit. So if there's a surplus, you debit the asset. If there's a deficit, you certainly credit the asset.
Oh, yes.
Because you are reducing. So down there, you credit your equity or your revaluation surplus. So that it balances, your asset balances, because it was 5, and the depreciation, after you have revalued, your asset has gone to 6, meaning that you introduce an extra 1, which will be debited. Down there on your credit, you credit your equity or your revaluation surplus. Similarly, opposite with a decrease.
Decrease, yeah.
I already explained these things.
Oh, yeah.
Here now is where you're actually looking at the components, componentization. It's a very difficult way to pronounce. You need to be very so that you don't sound a bit bumpy. Read it out faster.
Where which one? An
Yes,
asset is
this
a
one.
component.
Componentization. Yes. It's very difficult. All you're actually saying is that the assets are actually being componentized. I don't know how I can say it, but you're looking at components like this, where you have all this. So read it for me.
Natulu. Come and read this words. I'm calling my daughter. Natulu. Come and read this word.
Componentization.
She's laughing. Say hello to my lecturer. Say hello.
Yeah, read
That's
it,
what's
read
that word?
it, read it.
Say it out loud.
Component.
Components.
Mm-mm.
Which word now? Is that the one you're talking about, Fitz? An
This
asset
one,
with the
there's a Z here, not components.
No, but what am I looking at? You haven't changed the slide then?
No, I haven't. I've changed the slide. It was here, then we're going this side. This word,
Which one?
the one that I've circled.
Yeah, we can't see it. Okay, that's why it hasn't moved.
What are you saying?
An asset with the components included with a different UEL. The one that was there previously this whole time. This could be something like land and buildings. Basically,
Yeah,
if you
you
take
can't see this.
Which word?
But what are you saying here?
Just what I've explained to you.
What picture are you seeing?
The rail line, the rail track.
Rail track. Hmm.
Yes,
How? How?
it is the rail track, right? Yeah.
Mm.